Hey guys, what's up? Hello everyone. Hi everyone. So as you know that we've been doing the NCRTs, we've been covering the NCRTs, and we've been doing we've completed 4 chapters. We are on the fifth chapter right now, right? So as you know that we had started with chapter number 5, and we were talking about multiple things with respect to the chapter. So let's have a look. This was chapter number 5 that we were doing in the previous session. So, just to recapitulate the structure, the name of the chapter was The Government. Introduction to Macroeconomics, Government. Introduction to Macroeconomics is the book, Part 2, Class 12, and the name of the chapter is The Government. This is the structure of presentation. Role of government. Focus on 3 functions: allocation function, distribution function, stabilization function. Public goods versus private goods, role of government. Second is government budget. Second is government budget, revenue account, capital account. The third is measures of government deficit. Measures of government deficit. Fourth is fiscal policy. And the fifth is issue of debt. So, role of government, government budget, measures of government deficit, fiscal policy, issue of debt. So we are doing all the measures in order to be able to understand what is going on in terms of structure of presentation. So we have understood that how the government has ascribed its role, how is the government's role multifaceted. Government is providing all the services. So government is providing all the services in a proper fashion. Government is making sure that the people have access to everything. So multifaceted or international relations, all these things are being provided by the government. The government's role is multifaceted. There are three distinct functions of the government. So, in this particular case, the operation is through the revenue and expenditure measures of the government budget. This is what we had understood yesterday. We were discussing about the government budgeting aspect, the revenues and expenditures. Revenues and expenditures, that is what we were discussing. This is something that was being discussed by us. Revenue account, capital account. So let's continue with the same. It is the government budget that we were talking about. Further, the budget must distinguish expenditure on the revenue account from other capital expenditures. Simply speaking, budget is a summarized version of revenues and expenditures. Budget is a summarized version of revenues as well as expenditures. Revenues, expenditures, it is a summarized version. Revenues and expenditures. What we are trying to say in this specific sense is that all the revenues and all the expenditures are categorized into 2 types. They are categorized into 2 types. The first is revenue in nature and the second is capital in nature. The first is revenue in nature and the second is capital in nature. The budget must distinguish expenditure on what? On the revenue account from other capital expenditures and from the capital account. So budget comprises of what? Revenue budget, capital budget. It comprises of revenue budget and capital budget. What is revenue budget? Revenue budget is where we take into consideration the revenue receipts as well as revenue expenditures. Revenue receipts and revenue expenditures are taken into consideration. These include the current account receipts and the current account expenditures. The current account receipts and the current account expenditures taken into consideration is a part of revenue budget of the government. So in other words, the revenue budget is all about short term, or revenue budget is all about day-to-day budget. Day-to-day budget includes day-to-day receipts, day-to-day expenditures. It is day-to-day. Everything is day-to-day. Revenue budget is all about short term, up to 1 year, revenues and expenses of the government. It can be further subdivided into revenue receipts and revenue expenditures. The further subdivision is done on what basis? It is done on the basis of revenue receipts and revenue expenditures, revenue budget. Followed by that, the second is capital budget. Capital budget is whatever budget you have prepared, receipts and expenditures, they are for the long term. Long term means that they are for a period of more than 1 year. It is not specifically 1 year, but it is a long-term receipt or a long-term expenditure. Revenues and expenses in the long term of the government. So they are divided into what? They are divided into capital receipts as well as capital expenditure. Revenue receipts, revenue expenditure, capital receipts, capital expenditure, revenue budget, capital budget. This is something that we have. So always remember the specific two parts, revenue receipts and revenue expenditures. Revenue receipts are receipts of the government. Revenue receipts are receipts of the government which are non-redeemable. I repeat, revenue receipts are those receipts of the government which are non-redeemable. That is, they cannot be reclaimed from the government. Whatever we have given to the government, that is for the basic consumption that we have to give. You cannot escape that. So indirect taxes are the taxes which one has to give to the government of India. That is not something that can be taken back. So they cannot be reclaimed from the government. Revenue receipts are receipts of the government which are non-redeemable. When we talk about non-redemption, it is something that you cannot claim, and that is not something which would give you any long-term benefit. This is considered to be revenue receipt. So revenue receipt of the government of India is whatever you have charged in the form of taxes, whatever revenues you have taken in the form of taxes, whatever fees or utility charges or interest that the government of India has charged is included in the revenue receipts. So revenue receipts are divided into two parts, taxation receipts, non-taxation receipts. I repeat, taxation receipts, non-taxation receipts. Taxation receipts, revenue receipts, the first thing it includes is taxation receipts or taxation revenues. An important component of revenue receipts. An important component of revenue receipts comprise of direct taxes. The first thing is direct taxes, which fall directly on individuals. So direct taxes fall directly on individuals, personal income tax, corporation tax. Personal income tax is income tax on persons, individuals, and firms is the corporation tax, corporate tax. And indirect taxes like GST, goods and services tax, as well as customs duties. So direct tax, indirect tax, taxation revenues. Direct tax, indirect tax are the taxation revenues which are a part of revenue receipts. You pay them unknowingly or knowingly on a daily basis. Right now, I'm sitting over here. I'm consuming my laptop. The purchase of this laptop had an element of GST. I'm using earphones. It had an element of GST. I'm using a Wi-Fi connection on which again I pay GST. I'm using the electricity on which I pay GST. I'm paying GST on four things right now while teaching all of you. And all of you are also paying GST while attending my lecture, while watching YouTube. So you have basically seen you are paying for internet charges, you are paying for electricity, you have also purchased a laptop. All of these things, they include a portion of GST. Direct tax, indirect tax. The other direct taxes like wealth tax, gift tax and estate duty, they have now been abolished. They have never been of much significance in terms of revenue yield, and thus they are referred to as paper taxes. They are called as paper taxes. We are talking about revenue receipts. The redistribution objective. We are talking about revenue receipts. The redistribution objectives. Redistribution means you are redistributing. You are redistributing from the taxation, whatever taxes you have charged and whatever taxes you have paid. What the government adopts is called as the Robin Hood approach. Whatever the government is adopting is called as the Robin Hood approach, that government is taxing the rich and distributing amidst the poor. It is sought to be achieved through progressive income taxation, in which higher the income, higher is the tax rate. Higher the income, higher is the tax rate. Lower the income, lower would be the tax rate. The redistribution objective or the distribution function of the government. It is sought to be achieved through progressive income taxation. The progressive income taxation is richer a person gets or increase in income attracts higher rate of tax. So let's say you are earning up to 2,50,000, you are subject to 0% taxes. From 2,50,000 to 5 lakh, you are subject to 10% taxes. After that 20%, after that 30%. Above 50 lakhs is 30% taxes plus 10% surcharge. Above 1 CR is 30% taxes plus 15% surcharge. On top of that, there is 3% education cess and secondary higher education cess. So taxes keep on increasing. Taxes keep on growing. They keep on growing right from lower income bracket to higher income bracket to highest income bracket. 1/3 taxes and all are given. So this is the redistribution objective. Distribution function of government is sought to be achieved through progressive income tax. in which higher the income, higher is the tax rate. So higher the income, higher will be the tax rate. That is understood through redistribution objective. Firms are taxed on a proportional basis, where the tax rate is per particular proportion of profits. Tax rate is a particular proportion of profits. This is supposed to be understood. So with respect to other taxes like excise taxes, necessities of life are exempted or taxed at lower rates. Necessities of life are exempted or taxed at lower rates. Comforts, semi-luxuries are moderately taxed. Luxuries, tobacco, petroleum products are taxed heavily. It is seen because luxuries are afforded by rich people. So rich people, if they can afford to pay for luxuries, they can also afford to pay taxes on those luxuries. Same goes with this. So it is not the same concept with tobacco or liquor, but tobacco is something that government is trying to discourage. So it increases the taxation rate on tobacco. Same goes with liquor. Petroleum products, they are also taxed heavily. In fact, petroleum is a state subject where state governments are levying taxes on petroleum, which is why the rate of petroleum differs from state to state. Rate of petroleum is differing from state to state, as you may have observed. This is called as the redistribution objective. This followed by this, the second is non-taxation revenue. Taxation revenue, non-taxation revenue of the central government mainly consist of interest receipts on account of loans by the central government, dividends, profits on investment made by the government, fees and other receipts for services rendered by the government. Non-taxation revenue. Non-taxation revenue of the central government mainly consists of, it mainly consists of what? Interest receipts on account of loans. Whatever loans had been given by the central government, so government would receive interest on that. Now when it comes to loans, you have to understand two specific things. You have to have a clear division of two things in your mind. The first is the principal amount of loan, followed by that the second thing is interest amount on loan. Principal amount, interest amount. The principal amount would always be of capital nature. I repeat, the principal amount of loan would always be of capital nature. If you take a loan, then it would be considered to be a capital receipt. When you repay a loan without interest, it would be considered to be a capital expenditure. The interest element of whether you are receiving interest on loans given or paying interest on loans taken, in both the cases, the interest amount or the interest receipts are to be there as a part of what? Are to be there as a part of revenue receipts and revenue expenditures. So revenue receipts are interest receipts, whatever loan that government of India would have granted to state governments or to have whoever is forming a part in this case. That is something that we have taken. Followed by that, revenue expenditure would be interest paid on loans which we had taken. So interest receipts or interest expenditures on the loans by the central government is something that is included as a part of non-taxation revenue. It is included as a part of non-taxation revenue. One. Followed by that, the second is dividends and profits on investment made by the government. So dividends and profits on investment made by the government, whatever investments have been made by the government, whatever dividends and whatever profits that the government makes. So there are so many PSUs, public sector undertakings. There are so many PSUs. How do the PSUs, they specifically state? What do the PSUs state? They are government companies. Whenever PSUs are making profits, they distribute dividends to their shareholders. Same goes with PSUs. They distribute dividends. If government is the only shareholder, which means it's an entirely 100% government company, then government would get all the dividends. So government would be making dividends. Whatever dividend income the government would get, it would be credited to the consolidated fund of India. That is considered to be a non-taxation revenue. Interest income is considered to be a non-taxation revenue. Fees and other receipts for services rendered by the government. Whatever services are being provided by the government, if it charges some fees, receipts, penalties, interest, all of these things, they are included as a part of non-taxation revenue. So simply speaking, non-taxation revenue would be that revenue which is specifically not taxes, because taxes is separate, and it is not something that can be put in the capital account. It is day-to-day revenue, but it is not taxes. If it is day-to-day revenue and not taxes, it is called as what? It is called as non-taxation revenue. This is something which is included in non-taxation revenue. Followed by that, the next thing is cash grant in aid from foreign countries. Cash grant in aid from foreign countries and international organizations are also included. Now again, there are two things. The first is loan, which is granted to you or which you take. So loan comes to you with an obligation to be repaid. One has to repay the loan. One has to give the loan back, when the amount of loan back, loan amount. The second is grant in aid. Grant in aid. What is meant by grant in aid? Whatever money has been granted to you through grants, that is not something that has to be paid back. It is not something that has to be there is no obligation to pay it back. Cash grant in aid from foreign countries and international organizations, they are also included. So cash grant in aid from foreign countries and international organizations are also included. So always remember that loan amount principal is always capital in nature, grant amount is always revenue in nature. Revenue receipts and revenue expenditures. Grant and aid. Revenue expenditure. So that was revenue receipts. Revenue receipts are further categorized into taxation revenues, non-taxation revenues. Followed by that, the next is revenue expenditure. Revenue expenditure is what? Day-to-day expenditure. Government of India, in order to maintain utility bills, operations, maintenance, subsidies, defense, all these are day-to-day expenses. Salaries, pensions, they have to be done. You can't escape that. Government of India cannot escape that. So all the expenditures which are supposed to be made, and they are regular or day-to-day expenses, they are called as revenue expenditures. Revenue expenditures is expenditure incurred for purposes other than the creation of physical or financial assets. Expenditure incurred for purposes other than the creation, of physical assets or financial assets. So other than the creation of physical assets or financial assets of the central government is added to what? It is added to revenue expenditures. So it is expenditure incurred for purposes other than the creation of physical assets or financial assets of the central government. This is called as what? It is called as revenue expenditures. There are certain examples. Now have a look at examples. It relates to expenses incurred for the normal functioning of the government departments and various services. Expenses which are incurred for the normal functioning of the government departments and various services. These are again maintenance and operational expenditures. Followed by that, the second is interest payments on debt incurred by the government. Interest payments on debt. When I say interest payments on debt, what I mean by that is, what do I mean by that? That whatever loans that we had taken, again the same thing. Principal amount of loan is capital in nature. But when we take interest payments, so whatever loan we had taken, we have to pay interest on that. So whatever interest you pay, it is of revenue category. It is of revenue in nature. Interest payments on debt incurred by the government. Third is grants given. Just like central governments or government of India gets grants, they have to also give grants. So when they give or grant given to state governments and other parties, that is something which is included over here. Grants which are given. Followed by that, subsidies, defense expenditures, pensions, civil administration, other expenses. All of these are day-to-day expenses. I repeat, all of these are day-to-day expenses, which is why they have been taken into consideration as a part of revenue expenditures. So remember this, it is a part of revenue expenditures because of this very reason. Revenue expenditures. So revenue expenditures taken into consideration. Expenses incurred for normal functioning, expenses incurred for this purpose, all of these things are added under revenue expenditures. Now we come to the capital account. What is a capital account? It is a long-term account. Long-term account or capital account. When we talk about long-term account or when we talk about capital account, what is it that we are specifically talking about? Any kind of receipt or expenditure, anything, any kind of receipt or any kind of expenditure, what you are doing is long-term in nature. When we say it's long-term in nature, what do we mean by that? We specifically ascribe to one thing, and that is that it has to reap benefits in the future. Let's say you have spent 1,000 crores on making a highway, a national highway is being built, or 100,000 crores on making a bullet train. That is a capital expenditure. The capital expenditure which is being done, it is being done for the next 100 years. Now bullet train has been instituted for that purpose. The capital account is an account of the assets as well as liabilities. So account of the assets as well as liabilities of the central government, which takes into consideration changes in capital. This is what capital account is. Account of the assets as well as liabilities. All the assets as well as liabilities Capital account of the central government, it takes into consideration changes in capital. This is called as capital account. It consists of capital receipts and capital expenditures of the government, the capital receipts and the capital expenditures of the government. So capital requirements have capital receipts and capital expenditures. Account of the assets as well as liabilities within the capital account is included in this part. So the first thing that we study within capital account is capital receipts. Capital receipts are what? Obviously, if we are talking about long-term expenditures, when we talk about capital expenditures, then capital receipts would be long-term receipts. What are those? So capital receipts are categorized into two types. The first receipts are called as debt receipts. The second receipts are called as non-debt receipts. Debt receipts, non-debt receipts. Debt receipts. Debt receipts or debt revenues. Debt receipts are principal amount of loan. Whatever loan you have taken, the principal amount, it would be added or it would be included as a part of capital receipts. It is a debt adding receipt. What are we saying? It is a debt adding receipt. When we say that it is a debt adding receipt, what are we actually ascribing to? What are we saying? That it has created a debt on you. So when we say that it has created a debt on you, what is it that we are talking about? We are just talking about one thing, and that is debt revenue. Debt receipts or debt revenue, something that we are talking about. So that is debt revenue. The second is non-debt revenue. So let's read about or let's study about non-debt revenue. Whatever loans had been given by the central government and you have recovered a principal amount of those loans, it has been added to non-debt revenues. It has been added to non-debt revenues. Recoveries of loans, it is not something which is to be paid back. It is not something which is an obligation on you. It is something that you receive. Recoveries of loans granted by the central government. Sale of assets by the government. Sale of assets. You have to sell the assets or sale of assets by the government. Government has to sell the assets. Sale of assets by the government. Followed by that, the third is small savings. PO savings accounts, national savings certificate. All the deposits which are being done, provident fund deposits which are being done, all these are obligation on the government, by the way, because if I have opened my PF account and I have deposited the amount in my PF account, that is an obligation on the government because I will get that money back after a certain point in time. And net receipts obtained from disinvestment. Disinvestment means dilution of your own equity in the stock market in front of the public. So disinvestments the government of India carries out of the PSUs. There are so many PSUs, Maharatna, Navaratna, Mini Ratna, all these are PSUs of government of India. There are certain, so what all these are PSUs, public sector undertakings, all these are government companies, Sarkari companies. When we say that it is a Sarkari company, it simply means that 100% shareholding is with the government of India, at least when it would have started. So if ONGC came into existence as a corporation in 1994, 100% equity was owned by the government of India. Now government of India says that we want to raise some money to expand ONGC, to diversify ONGC into ONGC Videsh Limited. So funds are required. So what did government of India do? It disinvested a certain percentage of share. 100% shareholding, certain percentage, let's say 10%. 10% of the share has been diluted in front of the public. They would raise money equivalent to 10% and they would invest that 10% in some other unit. So the receipts which are obtained from disinvestments, whatever money you obtain from disinvestment is considered to be a capital receipt. So what are the capital receipts? Recoveries of loans, one. Sale of assets by the government. When the government auctions assets, let me give you examples of sale of assets, like auction of 4G or 5G licenses now. Whatever receipts you get, they are considered to be capital receipts. Auction of coal blocks. It resulted into government earning 2 lakh crores, 1,86,000 crores. What is that? That is non-debt revenues. Net receipts obtained from disinvestments. Whatever money you get, it is a part of non-debt revenues. All these revenues are capital in nature, but they don't create a debt on the government of India. They are non-debt creating revenues. So debt revenues, non-debt revenues, Debt revenues they include loans received by the government by either internal sources such as the market, RBI or domestic financial institutions, or external sources. Basically, debt is a debt, loan. Wherever you may take it from, irrespective, you may take it from internal sources, you may take it from RBI, you may take it from people, general people by issuing bonds, that is also a debt. You may take it from external sources like, for example, regional banks, ADB, AIIB, BRICS Bank, or you may take it from World Bank or IMF. You may take it from any institution. Ultimately, it's a debt. So whatever loans you take and it adds a debt on you, it is considered to be a debt revenue. Followed by that, the second is non-debt revenue, recoveries of loans granted by the central government, sale of assets by the government, as well as net receipts obtained from disinvestment, small savings, PF, etc. All these things are included, capital receipts. Followed by that, the second is capital expenditure. The second is capital expenditure, capex. Capital expenditure is when you are spending money on long-term things. So capex or capital expenditures of the government are those expenditures which result in the creation of physical assets or financial assets or reduction in financial liabilities. So when we talk about capital expenditures of the government, they are those which result in creation of physical assets or financial assets. So if the government of India spends in making a college, in making a road, in making a stadium, in making a highway, in making any structure, it is considered to be a physical asset. So that is something which has been ascribed to capital in nature. So now government of India is spending 100,000 crores on making a bullet train. That is considered to be a capital expenditure. Government of India is spending thousands and crores in making infrastructure in India. That is considered to be a part of capital expenditure, physical assets. Followed by that, the second is financial assets. Financial assets, reduction in financial liabilities. Financial assets or reduction in financial liabilities. So creation of physical assets or financial assets or reduction in financial liabilities. So when we talk about financial assets or reduction in financial liabilities, we are talking about this, and what is it that we are ascribing to? What is happening? Financial assets or financial liabilities. That you are trying to, when you repay, the loans that you had taken, Government of India had taken a loan of, let's say, 5,000 crores principal amount, and principal amount is being repaid. So when you are repaying money, when you take that principal amount, it is capital receipt. When you are repaying that money, it is capital expenditure. That kind of capital expenditure would reduce your liabilities. Reduction in financial liabilities, financial assets or financial liabilities, highly important. Capital expenditures. These include expenditure on the acquisition of land, building, machinery, equipment, investment in shares. So acquisition of land, building, machinery, equipment, investment in shares. So all these things, if the government of India is acquiring land, it would be or building or machinery or equipment, it would be considered to be capex. Government of India is buying back the shares or investing in some place, some PSU, or in some other company, some other venture, that is also considered to be capex, capital expenditure. Followed by that, loans and advances by the central government to state and union territory governments, PSUs and other parties. Loans and advances by the central government. When you grant loans, when you give loans, don't use the word grant, you'll get confused. But when you give out loans or advances, it creates an obligation on the other person. So that loan or advance that you have given, it is what? It is something that you have to take from them. It is something that results into what? It is something that results into a liability on the other people, and for you it is considered to be a capital expenditure. आपके लिए क्या कहा जाता है? Capital expenditure कहा जाता है. Repayment of past loans. So repayment of past loans is taken into consideration. Repayment of past loans. Past loans, we are talking about repayment of past loans. So whatever are my past loans, I have to repay them. You have to keep on repaying them. Expenditure on the acquisition of land, building, machinery, equipment, loans and advances by the central government, repayment of past loans. All of these things are included as a part of capital expenditure. These are a part of capital expenditure. So capex or capital expenditures have been taken into consideration. So please remember this. So this is something this is an entire structure. Union budget, it has capital account, revenue account. So capital account is further divided into capital receipts and capital expenditures. Capex, capital receipts, capital expenditures. Capital receipts are further divided into debt receipts and non-debt receipts. So debt receipts, non-debt receipts are called as capital receipts. Debt receipts are what? Internal debt receipts. Internal debt matlab whatever debt you have raised from internally, from the people. External debt is whatever debt you have raised from international institutions, other countries, governments, whatever debt you have raised from them. Debt, internal debt, external debt. Then you have non-debt. Capital receipts, non-debt. Sale of assets by the government. When you sell off assets, recovery of past loans given to states, UTs and PSUs. Receipts from disinvestments, whatever amount you receive from disinvestment, small savings, provident funds, these are all non-debt receipts. Debt receipts, non-debt receipts are capital receipts. On the other hand, capital expenditures, loans which are given, whatever loans you grant, they are called as capital expenditures, principal amount. Repayment of past loans, whatever past loans you have taken, now you are repaying them, that is also considered to be a capex, capital expenditure. Expenditure on infrastructure, whatever expenditure you are doing on infrastructure is also a part of capital expenditure. So this is capital expenditure. Revenue account, revenue receipts, taxation receipts, non-taxation receipts. Taxation receipts are direct taxes, indirect taxes. Non-taxation receipts are dividends and profits from PSUs. Non-taxation receipts, dividends and profits from PSUs are non-taxation receipts that I just explained. Interest income on loans given by the government. Whatever loans had been granted by the government, whatever income you are getting, interest income you are getting on loans, that is something which is added NTR, non-taxation receipts. Selling of goods and services. You have sold your goods and services, they are called as non-taxation receipts. Grants received by the government, grants which are received by the government, grants, they are called as non-taxation receipts. Fees, fines and user charges, non-taxation receipts. Income from minting, whatever the government of India is earning, that is considered to be a non-taxation receipts. All these are non-taxation receipts. Prominently non-taxation receipts are interest income, grants and fees, fines and user charges. So these are non-taxation receipts. Followed by that, revenue expenditure. When we say revenue expenditure, what is it that we are referring to? What is it that we are referring to? Revenue expenditures. Interest paid. Interest which has been paid, followed by that grants which have been given, subsidies given, defense, pension, civil administration, law and order. So interest paid, grants given, subsidies, defense, pension, civil administration. All these are a part of revenue expenditures. Capital account, revenue account, capital account further divided into capital receipts, capital expenditure, revenue account further divided into revenue receipts and revenue expenditures, and they have been further categorized. This is within union budget. Union budget में आता है. Followed by that is government budget. Government budget is a summarized version of revenues and expenses. Government budget is a summarized version of revenues and expenses. So it depends. Revenues exceeding expenditures or vice versa results into a surplus or a deficit. Revenues exceeding expenditures are surpluses. Expenditures exceeding revenues are deficits. Fiscal Responsibility and Budget Management Act, FRBMA, Fiscal Responsibility and Budget Management Act, enacted in 2003, the FRBMA requires the elimination of revenue deficit by 2008-2009. Eliminate what? Revenue deficit. Elimination of revenue deficit by 2008-9. This means that from 2008-9, the government will have to meet all its revenue expenditures from its revenue receipts. So what does it mean? That from 2008-9, the government will have to meet all its revenue expenditures. Government has to meet what? It has to meet all the revenue expenditures from its revenue receipts. Revenue expenditures from the revenue receipts that you have to basically, so it makes sense. Whatever you are receiving, you have to spend from those receipts. That is something that we have to achieve. Any borrowing would then only be met or only be to meet capital expenditure, repayment of loans, lending and fresh investments. Whatever borrowing you are doing that only for meeting out capital expenditures. Now please try and understand what are we trying to say over here. This is something which was explicitly stated by the FRBMA. So if we categorize, these are revenue receipts, revenue expenditures. If revenue expenditures are met by revenue receipts, let's say revenue receipts are sufficient enough to take care of revenue expenditures. They are sufficiently enough. Revenue receipts are higher than revenue expenditures. Revenue receipts are equal to revenue expenditures, and that is something they are able to absorb the entire expenditure. So you don't have to worry about revenue expenditures. Then you can concentrate upon capital expenditures, capital receipts and capital expenditures. Whatever capital expenditure government of India is doing, whatever capex or capital expenditure government of India is doing, that is something that we need to understand as a part of capital account. I repeat, we have to understand as a part of capital account. So capital expenditures, capital account, that needs to be understood. So capex or capital account, capital expenditure, within capital account, capital receipts. Basically what happens is that in developing economies, government of India has to spend a lot on infrastructure creation. So capital expenditures are always very high. They are always on a higher side as compared to capital receipts. So there is always a deficit in the capital nature of account. And trust me on that, capital nature of account should always have deficits in a developing economy. It basically means that government of India is spending and that expenditure is required. उस खर्चे की जरूरत थी, वरना वरना तो आप क्यों करते? Why would you have done? So you require that kind of expenditure. Capital expenditure greater than capital receipts. Before that is revenue account. Revenue account is what? Revenue expenditure, revenue receipts. We wish that revenue expenditures should be met through revenue receipts, but that seldom happens. So any borrowing would then only be met or only be able to meet capital expenditures, repayment of loans, lending and fresh investment. The Act also mandates a 3% limit on the fiscal deficit after 2008-9. So 3% limit on the fiscal deficit after 2008-2009. This is a reasonable limit that allows significant leverage to the government to build capacities in the economy without compromising fiscal stability. So mandates a 3% limit on fiscal deficit. There is a 3% limit on fiscal deficit after 2008-2009. There is a reasonable limit that allows significant leverage to the government. A significant leverage to the government can be allowed to build capacities in the economy. Economy capacity is built on capital nature of expenditure, and for that you have to spend more. Capital nature, not revenue nature. So that leverage that government of India can be given without compromising fiscal stability. So here we learn how to calculate deficits as well as surplus. So in case of revenue accounts, what is happening that, let's say, when revenue receipts are higher than revenue expenditures, we call it a surplus situation. It is called as revenue surplus situation or revenue surplus. Vice versa, on the other hand, revenue expenditures are higher than revenue receipts. If revenue expenditures are higher than revenue receipts, they are considered to be what? They are considered to be deficit-like situations. So revenue expenditures are higher than revenue receipts. They are considered to be like deficit situations. So surplus, deficit, two situations. Followed by that, the second is capital account. Capital account is capital receipts and capital expenditure. Capital receipts and capital expenditure. If capital receipts are higher than capital expenditures, if CR capital receipts are higher than capital expenditure, it is resulting into a surplus, and vice versa, expenditures being higher than receipts are resulting into deficits. This is the basic understanding, deficit as well as surplus. So when we talk about the difference between revenue receipts and revenue expenditure, capital receipts and capital expenditure is coming within what? It is coming as a part